Bizbee, the insight you need. I'm Junfeng. Share prices of Chinese companies listed on the Chinese mainland bourses in Hong Kong and New York have been staging a rebound in the past few days. The uptrend started after a rare policy meeting in Beijing on Wednesday, March the 16th. When Vice Premier Liu He chaired a special meeting of the Financial Stability and Development Committee of the State Council. This meeting was held against a backdrop of massive stock sell-off in the weeks prior to the meeting, triggered by a host of reasons like COVID-19 outbreaks, regulatory moves from China and the US, and the Russian-Ukraine conflict, and an imminent US interest rate hike. The meeting addressed almost all of these concerns. It said China will cooperate with the US regulators about Chinese companies listed on Wall Street, and that the government would, quote, continue to support all kinds of enterprises to float. The meeting announced that China will, quote, actively release favorable policies for the markets, unquote, and make sure that any regulation that could have, quote, a significant impact on the capital markets, unquote, will be coordinated with financial management departments in advance. At the same time, the meeting said through standardized, transparent and predictable regulation, authorities will complete the ratification of large platform companies as soon as possible. Vice Premier Liu He said the long-term institutional investors will be allowed to increase their shareholdings, while communication with Hong Kong regulator would be a step up to maintain financial market stability. All of these developments gave the market the much-needed fillip. This rare meeting also showed that authorities are abreast of the stock market activities, viewed it as an important investment channel for over 200 million Chinese individual investors, and see it as a key financing channel for China's best companies and tech unicorns. Policymakers are also clear that a downward trend in the market is not conducive for all stakeholders or the overall economy. Several fund managers told me last year that China's regulations on tech platforms and the tutoring industry had surprised and confused foreign investors, and some had decided to trim their China portfolios. Though they believe that China had good intentions, the intended messages did not percolate down to the market level in a proper manner. And that's exactly what the March 16 meeting has addressed. By improving communication with the market entities before issuing policies, will help the policymakers to further stabilize their expectations. Investments is all about expectations, and investors hate uncertainty of any kind. What the meeting did was help restore confidence that Chinese policymakers are adapting to the ever-changing market needs. They have shown that not only do they care about the health of the capital markets and investors, but also their responsibilities and need to be more approachable.